Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today I thought I'd talk a little bit about deciding whether you want to be a C corporation or a pass-through entity. Now, if I've lost you already, I apologize, but we're going to get into this a little bit today. And the reason we're going to talk about this is the new 21% corporate federal income tax law that went into effect with the Tax Cuts and Jobs Act. So, this was an article by Bill Bischoff. It ran on MarketWatch July 2nd, 2018. And I thought that this particular author did a great job of explaining some scenarios where we can make real life decisions. Now, let's start with this. The Tax Cut and Jobs Act forces taxpayers to reconsider whether business ventures should be conducted as a traditional C Corp, like, big corporations, or as a pass-through entity. Now, a pass-through entity could be something like a sole proprietorship, a single member LLC, a partnership, or an LLC taxed as a partnership or an S corporation. Now, the whole reason we're having this discussion now is we've got this new flat 21% corporate tax rate. The other big factor is the qualified business income deduction, or what I'm going to call in this discussion QBI, which is available to individual owners of pass-through entities. This deduction could be up to 20% of your share of the pass-through QBI. Now, the whole point of this discussion is when Congress made the decision to reduce the corporate tax rates from 35 to 21%, they wanted to level the playing field as well for those entities that were pass-through entities. So they didn't want to harm one group and help another. So before this tax code, conventional wisdom dictated that most business should be conducted as pass-through entities. And that's because the dreaded C Corp resulted in double taxation. Now, this double taxation still exists under the new law, but it's been toned down quite a bit because of this 21% corporate rate. So let's talk about some scenarios. Now, scenario one is a venture generates tax losses. If your main concern is deducting a business venture's losses, there's no advantage to operating as a C corporation. And that's because those C corporation losses cannot be passed through to owners. So if you know that a business entity is going to generate losses, the pass-through entity still becomes the best entity structure for that. So, you don't want to go into C Corp, but you consider, a multi-member LLC or an S corporation so that you can pass those losses back to you personally. Scenario number two. What about if a venture pays out all of its profits to owners? Now, there's really two results here. The first one is the results with the C corporation, and that is the maximum combined effective federal income tax rate on the venture's profits, including the 3.8 net investment tax, or NIIT, on dividends. So basically, you'd be paying yourself through dividends, is 39.8%. Now, how do we get that? It's 21% plus 20% plus 3.8% times 0.79. So you still have double taxation here. The 39.8 rate is pretty good. So because of that 21% tax rate, it's still pretty good. Now, that same result in a pass-through entity. Now, this is where, it's operated as a pass-through entity and pays out all the profits to you, the owner. Okay, the maximum effective federal tax rate on the venture's profits, including the 3.8% NIIT, or 3.8% for the Medicare tax portion of the self-employment tax, whichever applies, is 40.8%. Now, that sounds like that's a bad deal and it's higher than the other, but here's the deal. Here's the catch. If you can claim that full 20% QBI deduction, the maximum rate now drops all the way down to 33.4%. Now, remember, this QBI is only available between 2018 and 2025, unlike the 21%, which is forever. So conclusion, in this particular scenario, operating as a pass-through entity is probably the way to go if meaningful QBI, and we'll talk about that a little bit later, deductions are available. But operating as a C corporation might be a bit simpler from a tax compliance perspective. Okay, scenario number three. If a venture retains all profits to finance growth. Now, a lot of people use a C corporation to do this. And the reason they do that is eventually when they sell the shares and pay the federal income tax rate at a maximum 20% for long-term capital gains. So what this results in is a combined effective rate of 39.8%. And remember, the shareholder level on stock sale gains is deferred until the stocks actually sells. So if you're not going to sell it, you just keep it in deferred. Now, if the corporation is a small business corporation or QSBC, the 100% gain exclusion may be available for stock sale gains. So if the maximum combined effective federal income tax rate on the venture's profits can be as low as 21%, then that's the total tax you would pay on that. Now, looking at the pass-through entity for the same scenario where a venture retains all profits to finance growth, you're looking at a tax rate of 40.8%. Now, that's a bit higher than the 39.8% rate that applies with the C corporation options. The problem with the pass-through in this particular scenario is all taxes are due currently. You can't have retained earnings in a pass-through entity. Now, with the C corporation, shareholder level tax on stock sale gains are deferred until the shares are actually sold. So that's where, you can leave those gains in the corporation. But here's again, if you can claim the 20% QBI deduction, the maximum effective rate is reduced to 33.4%, which is significantly lower than the C Corp. So it looks again like as long as that QBI is available, best scenario is still the pass-through entity. Now, number 4. C corporations with all profits paid out as shareholder employee compensation and benefits. Now, what we're talking about here is closely held C corporations have historically sought to avoid double taxation by paying out essentially all corporate income to shareholder employees as deductible salaries, bonuses, and fringe benefits. So basically, they left no income in the corporation. Now, the other benefit to that is C corporations can provide shareholder employees with some tax-free fringe benefits that aren't available through pass-through entity owners. So in this particular scenario, C corporation still works well, except for the fact that there's no possibility of claiming the QBI deduction. So you wouldn't get the benefit of that QBI deduction. So if you were operating as a pass-through entity, you would open the door to a significant or 20% QBI deduction. So that's where it still may make sense to be in that pass-through entity. Scenario number 5, if you operate as an S corporation to minimize Social Security and Medicare taxes. Now, this has been the game that's gone on, since the dawn of this, that you've tried to pay yourself a modest salary in order to minimize Social Security and Medicare taxes. Now, with the Tax Act, this makes the strategy even more attractive for many businesses because it maximizes the amount of pass-through S corporation income that's potentially eligible for the QBI deduction. So, the bottom line with this is the new tax law, the 21% corporate rate, which is permanent, reduces rates for individual owners temporarily. The new QBI deduction, also temporary, shift the choice of entity playing field. Other things being equal, C corporations are now more attractive thanks to the 21% corporate tax rate, but pass-through entities are still preferred in some circumstances. So at the end of this discussion, it really depends on the particular nuances to your business. And that's why I would definitely recommend you talk to a professional accountant, a CPA, or a public accountant, and sit down with them and go over these scenarios and make sure that you're really maximizing this based on how your business operates. So I hope this discussion of the tax law change and how this affects entities was helpful. So do your homework and see what works best for you.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.